Okay, let's unpack this.
Let's do it.
Today, we are stepping directly into, what has to be one of the most resilient and just massive sectors of the U.S. economy.
Absolutely. We're talking large-scale residential real estate.
Specifically, we are diving deep into the multifamily sector. These huge apartment communities that house millions of people and represent, well, billions in invested capital.
Billions with a B. It's a world unto itself.
And the subject of our deep dive today is Camden Property Trust.
Right. Known everywhere by its NYSE ticker CPT.
And for anyone listening who might not be familiar with just how big institutional landlording has become, CPT is an undeniable heavyweight.
Oh, they're a major engine, a huge engine in the modern housing market.
So our mission here is really more than just, listing off a bunch of corporate data.
Right.
We're going to use their official filings, their historical records, their whole transaction history as a kind of blueprint. We want to quickly, but also thoroughly, grasp the operational strategy, the financial scaffolding, and the precise historical decisions that let this company become one of the largest apartment owners in the entire United States.
So think of it as getting a masterclass in how a real estate empire is actually built.
And managed.
And financially engineered from the ground up.
Exactly. And to really narrow our focus, CPT is what you'd call a pure play example.
That's a great point.
We're looking at a publicly traded company, a real estate investment truster that has just a razor-sharp focus.
Purely on apartments.
Purely on apartments. They aren't getting distracted by, logistics centers or office towers or retail.
No. Their entire strategy, all their success, is contained right there in the residential rental world.
So where do we start with a company this big?
Well, I think what's immediately fascinating here is CPT's dual public identity. It tells you so much about its stability and scale right from the jump.
What do you mean by dual identity?
This isn't just a large company. It's a pillar of the financial market. So one, it's listed on the New York Stock Exchange trading as CPT. That's standard for a big company.
Right.
But the real marker of its status, the second part of that identity, is its inclusion as a component of the S&P 500 index.
Okay, and that's the big leagues.
That is the big leagues. That inclusion is absolutely critical. It immediately signals a really high degree of liquidity, a ton of investor confidence, and a massive market capitalization that places it among the top corporate entities in the entire country.
So for you, the listener, what does S&P 500 inclusion really mean?
It means reliability. It means this is not a flash in the pan. And for the company, it means access to a lower cost of capital.
Which is everything in this business.
It is fundamentally essential when your entire business model is built on buying and developing billions of dollars worth of physical assets. So yeah, they aren't just some big landlord, they're institutional-grade infrastructure.
And the numbers absolutely back that up. When we look at the headline figures from their 2023 operations, the scale just becomes, real.
It becomes quantifiable.
We are talking about total revenue of $1.542 billion.
And that's the annual flow of cash generated from renting apartments, parking fees, amenity fees, everything that comes from managing their properties.
And just really put that revenue number into context, you have to look at the assets that are generating it.
Exactly. Real estate is an incredibly capital-intensive business. CPT's total asset base, which is, the book value of all their properties, their developments in progress, cash reserves, everything,
Wow.
clocks in at a staggering $9.383 billion. That's based on those same 2023 figures.
Wow. So nearly $9.4 billion in assets to generate about $1.5 billion in revenue.
And that relationship, that ratio right there, is what defines this industry. It means they're managing an immense amount of physical capital to generate that annual cash flow.
And that demands a level of operational efficiency that, frankly, smaller players just can't achieve.
They can't even come close.
So let's pull that abstraction, those billions of dollars, into something tangible, something you can actually visualize.
Okay.
The corporate records confirm that as of the end of 2023, CPT owned controlling interests in 176 distinct apartment communities.
176. And those communities collectively contain 59,800 apartment homes.
59,800.
Yeah, I mean, just think about that for a second. We're talking about managing the daily lives, the maintenance calls, the leasing, the entire cash flow related to nearly 60,000 separate residences.
The operational complexity is just mind-boggling.
It's a scale that very few companies ever achieve. It requires highly centralized systems, really sophisticated data analytics, and, I mean, a deeply ingrained management culture to run that efficiently.
And that is the foundation of their market power.
It is.
Exactly. The sheer scope is, it's hard to internalize. So now that we have this modern snapshot of CPT as a $9 billion titan,
Right.
we have to rewind the clock.
Right. How did this happen?
How does a company go from an idea in Houston, Texas, to owning nearly 60,000 apartments and getting a spot in the S&P 500?
It's an amazing story.
It is. And it begins with a fantastic entrepreneurial narrative.
Yeah.
But one that starts not with some grand vision of an empire, but with cleaning up a specific localized failure.
Which is often where the best stories start.
So the company was established 44 years ago, back in 1981, and its birthplace was Houston, Texas.
Mm-hmm.
The founders, and these names are key, Richard J. Campo and D. Keith Oden, they didn't begin by building brand new apartment blocks.
No, they did something much riskier.
They took a major risk. They acquired the actively failing Houston condominium business from their former employer.
And that initial act right there is so revealing. It tells you a ton about their risk tolerance and their strategic vision from day one.
Also,
Well, they weren't focused on new development or, easy, high-margin projects. They were focused on acquiring distressed assets at a discount and then reorganizing them.
so they saw value where others saw failure.
They saw salvageable value in the physical assets that somebody else had mismanaged operationally. And that distressed asset mindset, that capital discipline, would prove foundational to their much, much larger merger strategy later on.
And what they did immediately after that acquisition in 1981 was, it was the definitive strategic move for the company's entire future.
Absolutely critical.
They didn't just try to manage this failing condo portfolio in the traditional way. They immediately reorganized the whole business into a real estate investment trust structure.
And that decision back in 1981 is just so important historically.
Why then specifically?
Because the modern REIT structure was still kind of finding its footing, but it offered immediate and profound advantages. By structuring as a REIT, they could pool capital from a much wider range of investors.
And the tax advantage.
And the huge one, yes. Most importantly, they could avoid corporate income tax, provided they distributed the vast majority of their taxable income, we're talking 90% or more, as dividends to shareholders.
So for Campo and Oden, this was like pre-positioning them for growth.
Exactly. It prepositioned them for rapid tax-efficient expansion. That dividend yield structure, it attracts long-term investors who are just seeking passive income.
Which essentially guarantees a reliable source of equity capital.
The very thing a growth-focused real estate operator needs most. They basically locked in their financial DNA right at the very beginning.
And just a quick piece of sort of humanizing trivia here that speaks to their personal commitment. The name Camden.
Ah, yes.
It isn't named after a place. It's derived directly from the last names of those two founders, Richard J. Campo and D. Keith Oden.
Campo Oden.
Camden. They literally rooted the corporate identity in their own partnership.
It's a nice nod to their legacy for sure. But let's look at the immense corporate structure they built around that partnership. Even after more than 4 decades, if you look at the leadership as of 2023, you see remarkable stability.
Continuity at the very top.
Richard J. Campo is still the chairman and chief executive officer. He's the ultimate strategic leader guiding this massive portfolio.
And D. Keith Oden.
He serves as the executive vice chairman, so he's maintaining a vital oversight and long-term guiding role in the company he co-founded.
That level of co-founder consistency across 44 years is, it's almost unheard of in publicly traded companies.
Yeah, especially in volatile real estate markets.
It just suggests a really deeply entrenched and consistent philosophy on risk.
Right. And supporting them in managing the billions is Alexander J. Jessett, the chief financial officer, who's ensuring that financial rigor and, crucially, their access to capital markets.
So if we trace their path to getting the kind of scale required for that $9 billion asset base, there's one critical inflection point.
The IP.
The initial public offering in 1993. This was the moment they went from being a successful maybe high-risk regional operator into a national player capable of raising serious institutional funds.
That IPO opened the doors not just to equity capital, but to the debt markets in a huge way.
Yeah.
Suddenly, they had the currency, their publicly traded stock, and the credibility to go out and execute the massive portfolio-changing acquisitions that would follow.
And for anyone keeping track, despite that huge national reach, CPT maintains its corporate roots firmly in Houston, Texas.
Yep, right there at 11 Greenway Plaza.
So let's zoom out again and really analyze the operational empire they built from that foundation. Let's look at the 2023 portfolio data and define the actual footprint CPT holds in the national market.
And critically, how that scale translates into real market power.
Exactly.
Well, if we connect this back to their core strategy, that pure play specialization in apartments is really their greatest strength.
The focus helps.
It absolutely helps. This strategic choice lets them avoid the cyclical risks you see with commercial segments like office space or retail.
Which have been brutal lately.
Brutal. So this allows them to build just unparalleled expertise in residential management, in demand forecasting, and operational efficiency within that single product type. They are hyper-specialized, which really simplifies their operational profile.
And if we put numbers to that specialization?
176 apartment communities, 59,800 apartment homes as of the end of 2023.
And that unit count isn't static, right?
Not at all. It's
Yeah.
the result of continuous buying, selling, and development activity. It's always in flux.
And as we mentioned before, that unit count isn't just some internal metric they track. It places them very specifically within the industry hierarchy. The National Multifamily Housing Council, they meticulously track all these operators. And according to their latest data, CPT ranks as the 14th largest owner of apartments in the entire United States.
14th largest.
That top 15 ranking gives them immense market leverage.
It really does. It means they can command better terms from vendors for absolutely everything, from landscaping contracts to software platforms.
They get economies of scale in their management overhead.
And that national reputation means they are often first in line for prime development opportunities or when a distressed portfolio comes up for sale.
But here's where we need to dive into the technical depth of managing that size.
Right. This raises a really important question. What kind of financial metrics are required to acquire nearly 60,000 units, maintain them, and continue generating returns that are attractive enough to keep you in the S&P 500?
It's a high bar.
It's a very high bar. And we need to move beyond simple net income here. For a REIT, the critical metric is typically funds from operations, or FFO.
Can you break that down?
Sure. It's important because it strips away non-cash charges like depreciation.
Which is huge in real estate.
It's massive, but it doesn't reflect the actual cash generation of the business. So while their 2023 revenue was $1.542 billion and their official GAAP net income was $403 million.
Which is a strong number.
It's a very strong number, but the FFO figure, which is proprietary to REIT analysis, that gives investors the true measure of their ability to generate cash for dividends and for expansion. That $403 million net income is great, but FFO is the real operational test of efficiency.
And drilling into the stability of the balance sheet seems crucial here, too.
Absolutely.
We noted the total assets were just under $9.3 billion. But you also have to look at how those assets are financed. Their total equity, the money put in by the founders and all the shareholders, was $5.051 billion.
And this is a massive point of differentiation for them.
How so?
Well, when you do the math, when you calculate the equity to asset ratio, CPT is running with significantly more than 50% equity.
So more than half the company is funded by owners' money, not debt.
Precisely. And that suggests a highly strong and, frankly, a relatively conservative capital structure for a large-scale real estate company.
What do others do?
Many growth-focused REITs will often push their debt levels much, much higher. You'll sometimes see them running with equity closer to 30 or 40% of their total assets.
So CPT's higher equity buffer makes them more resilient.
Incredibly resilient, especially to economic downturns and rising interest rates like we've seen recently. This relative conservatism is a defining trait for them. It attracts investors looking for safety and sustainable dividends, not high-risk, high-leverage growth.
So they're sacrificing a little bit of that leverage growth upside.
For extreme stability and reduced exposure to market volatility, yes.
That focus on stability, though, it doesn't come cheap. It requires a massive human capital operation.
For sure.
To manage those 176 communities and 60,000 apartment homes, you need robust, staffing, and centralized operational systems.
Yeah.
The company employed approximately 1,640 people as of December 2023.
And that employee count, that is the operational engine that ensures the $1.5 billion in revenue keeps flowing.
These are the people on the ground.
These are the property managers, the leasing teams, the maintenance staff who are handling the everyday emergencies, and the long-term capital expenditure planning across nearly 60,000 front doors.
It just emphasizes that CPT is fundamentally a complex management and service business.
Operating on top of a multi-billion-dollar asset base. That's a perfect way to put it.
Okay, here's where it gets really interesting.
Mm.
As we trace the story of how they leverage that stable base to become the 14th largest owner, we've established their current position, but that journey is defined by a series of, colossal transactions.
Strategic mergers and calculated divestitures.
That allowed them to leapfrog competitors rather than just building up unit by unit.
Indeed. The history of CPT after its IPO is a textbook study in using public market capital to execute massive, transformative acquisitions.
They understood something fundamental.
They understood that achieving scale quickly, instantaneously integrating thousands of units, was the fastest way to drive down their per-unit operating costs and increase their market leverage.
And their early expansion, it really relied heavily on what we're calling mega mergers.
These were not small purchases.
No. These were company-making deals,
Mm.
and they were executed rapidly between 1997 and 2005, right after that 93 IPO.
A very focused period of growth.
Let's start with the Paragon acquisition in 1997. This was their foundational leap into national relevance.
It really was.
They acquired Paragon Group, which owned a substantial portfolio of 17,000 apartment units.
17,000 units in one fell swoop. That is the definition of achieving critical mass.
It instantly increased their portfolio size dramatically.
It likely doubled or even tripled its size at the time, and the price tag for that instant scale was $615 million.
So this deal wasn't just about buying properties.
No, it was about buying market share. It was about buying regional platforms and accelerating their growth timeline by years, maybe even a decade.
But they didn't really pause to digest that.
Not at all.
Just 1 year later, in 1998, they followed up with the Oasis Residential acquisition. And this deal is fascinating because it shows CPT's willingness to use significant leverage.
Which is a stark contrast to their typically conservative capital structure we just talked about.
Right. But they used it to achieve that necessary growth velocity.
Yay, this is where the dialogue gets really complex, and it's where we see their early risk-taking behavior kind of reemerge.
So break down the Oasis deal.
It was financially intricate. CPT paid $542 million in stock, which is pretty standard. But, and this is the crucial part, they also assumed $430 million in existing debt from Oasis.
Wow.
That assumption of nearly $500 million in debt is the critical analytical point. It let them close the deal without excessively diluting their existing shareholders by issuing too much new stock.
Which can kill your share price.
Can absolutely depress it. However, it also temporarily jacked up their leverage ratios, their debt to assets, and put immediate pressure on their cash flow to service that newly inherited obligation.
So it showed incredible confidence.
Immense confidence in their operational ability to turn those assets around quickly and cover that debt load. They were clearly playing to dominate the market.
So that period of aggressive, large-scale growth, it culminated a few years later with the definitive deal that really sealed their status as a top-tier national player.
The big one.
The acquisition of Summit Properties in 2005.
Mm-hmm.
This was the billion-dollar deal. CPT acquired Summit Properties in a massive $1.1 billion transaction.
$1.1 billion.
This move marked their final transition from a successful regional player with national ambition into one of the consistently recognized giants of the sector.
If the Paragon and Oasis deal set the stage, the Summit acquisition put CPT firmly in that top tier.
$1 billion nearly 2 decades ago was a huge sum.
It was a monumental sum, especially in residential real estate. And if you analyze the impact, you realize this deal wasn't just about unit count. It was likely about strategic geographic expansion.
Pushing them into new markets.
Pushing them into new, high-growth Sunbelt markets that were, and still are, essential for long-term portfolio stability.
So when a company executes 3 mergers of that magnitude.
In less than 10 years, they are fundamentally reshaping the entire competitive landscape. They are forcing their competitors to either consolidate themselves or risk being swallowed.
So the Summit acquisition was a signal.
It was CPT signaling that they were done being the target and were now exclusively the aggressor.
So after 2005, the pace seems to shift pretty dramatically.
It does.
We move from that era of mega mergers to a more surgical, a more targeted and tactical approach to managing their portfolio.
Especially in the wake of the 2008 financial crisis.
Right. And this reveals a highly sophisticated approach to really optimizing their asset base.
It's a different phase of the company's life.
Take the Texas expansion in 2011, for example. This was a highly specific geographical play. It kind of brings their history full circle right back to their home state.
It does. They acquired 8 properties in Texas for $261 million.
So what's the strategy there?
This type of transaction is pure optimization. CPT knows the Texas market, where they're headquartered, intimately, better than anyone.
They have a home field advantage.
A huge one. Acquiring 8 properties in one concentrated region allows them to realize maximum efficiency from their economies of scale. They can centralize maintenance depots, consolidate regional management, and gain local market pricing power.
All leading to higher net operating income per property.
Exactly. It's about deepening their roots where they already have the most expertise.
And then in 2012, we see another crucial tactical move that I think speaks volumes about their long-term control strategy.
The joint venture consolidation.
Right. They purchased the 80% interest held by a joint venture partner in 12 communities for $99.5 million.
This is textbook advanced REIT strategy, and it's vital for understanding how these giants manage their capital.
So why do a joint venture in the first place if you just plan to buy them out?
Because joint ventures, or JVs, are excellent tools for initial capital deployment. You get to split the risk and the massive upfront capital requirements with a partner, like a big pension fund or a private equity group.
So it lets you get into more deals.
Exactly. But, and here's the key, once the properties are stabilized, seasoned, and generating predictable cash flow, the strategic value of 100% control becomes overwhelming for a publicly traded company.
So by buying out the partner's 80% stake,
CPT eliminates the headache of shared governance, they streamline all future decisions, and they capture 100% of the future cash flow and any appreciation, all while simplifying their corporate reporting structure.
so it's a cleanup move.
It's a cleanup move that maximizes profitability and efficiency.
But the strategy wasn't just about buying and consolidating assets.
No, not at all.
It also involved strategic selling, what they called capital recycling, which is just as important in real estate.
Absolutely.
In 2016, we saw a very significant portfolio disposition with the sale of their Nevada properties.
A huge move. They sold their entire portfolio of properties in Nevada, 15 communities, encompassing 4,918 apartment units.
For a massive $630 million.
And this Nevada sale gives us a fascinating glimpse into high-level portfolio optimization. And you have to kind of challenge the conventional wisdom here.
Because selling nearly 5,000 units in a strong market like Nevada seems counterintuitive.
It does, unless you look at the strategic cost of maintaining scale.
What do you mean?
Was it pure capital recycling? Yes, $630 million is a large injection of capital to deploy somewhere else, but it could also have been an acknowledgement that they just failed to achieve the necessary deep market scale in Nevada.
So if they couldn't get big enough there, it wasn't worth it.
Right. If they couldn't reach, say, 10,000 units in that market to really maximize their operational efficiency, the profits being generated might not be worth the management distraction. By exiting Nevada, they concentrated their management resources and capital into higher growth core markets like Texas and the Southeast.
So they were effectively doubling down on their most profitable regions.
Exactly. It's a move that recognizes that efficiency is often geographic.
Right. If you have to fly regional managers halfway across the country for just 15 communities, it degrades your operational return.
Compared to managing 50 communities in a single state where you're already dominant, it's a no-brainer.
And their commitment to that JV consolidation strategy continued very recently, which reinforces that this is a core part of their playbook.
It is.
In 2022, they acquired the remaining ownership interests in their joint venture with the Teacher Retirement System of Texas.
And this absolutely reinforces the pattern established way back in 2012. If CPT initiates a JV, Their long-term patient goal is very often to secure 100% control over those assets once they prove their stability and value.
And acquiring those remaining interests is key because
It ensures that all the future financial upside from those properties flows directly to the CPT shareholders. It simplifies their corporate governance structure and maximizes their ability to make big capital decisions like major renovations or refinancing without having to consult an outside partner.
Okay, so we've thoroughly covered the snapshot numbers, the massive mergers, and the tactical asset management. Let's try to synthesize all of this rich history into a cohesive view of CPT's successful long-term REIT strategy.
Let's do it.
Reviewing this timeline, we see a clear, aggressive trajectory. They started with that high-risk distressed asset cleanup in 1981. They stabilized through the 93 IPO.
And then executed an acquisition blitz. Paragon, Oasis, and Summit in quick succession, culminating in 2005.
The continuous strategic logic here is the key takeaway, I think.
It is. Their history shows a clear and very effective dual pattern of growth.
Describe that pattern.
First, you have immediate, massive-scale acquisition Paragon, Oasis, Summit that instantly elevated their market size. Second, you have targeted surgical optimization through geographic deepening, like the Texas deal in 2011, and the essential consolidation moves like the JV buyouts in 2012 and 2022.
And this approach allowed them to build a highly adaptable platform.
Yes. A management system designed not just to run their existing assets, but to absorb tens of thousands of new units efficiently and simultaneously.
So they became a consistently dominant player when large, stable portfolios came up for sale.
Precisely because they had proved they could digest assets of that immense scale without massive internal disruption.
So what does this all mean when we synthesize the identity of Camden Property Trust?
I think their history is the definitive textbook case study. It demonstrates how a specialized, publicly traded REIT can achieve a dominant market position.
It shows that market dominance, being the 14th largest owner in the U.S. apartment sector, is achieved through a highly calculated series of financial maneuvers.
Multi-million and multi-billion-dollar mergers, like the $1.1 billion Summit acquisition, combined with strategic capital recycling, like the $630 million sale of the entire Nevada portfolio.
And the impact on the industry itself is profound.
Oh, it is. The constant movement of assets at this scale, whether it's integrating 17,000 units from Paragon or strategically offloading nearly 5,000 units in Nevada, it illustrates the fluidity and the velocity of capital within the high-end U.S. apartment market.
It's a market where only those with strong balance sheets and operational mastery can really survive.
And where billion-dollar transactions are simply the cost of staying relevant.
And critically, that fluidity is managed by having a strong balance sheet.
That 50+% equity ratio we talked about.
Yeah.
And a clear long-term operational goal. Maximizing efficiency and achieving 100% control over the highest performing assets they operate. Their conservatism is, in a way, their weapon.
That brings us to the end of this extensive deep dive into CPT's foundation and strategy. So let's recap the core facts and analyses you should carry forward from this.
Okay.
Remember the origin and the continuity. Founded in 1981 in Houston by Richard J. Campo and D. Oden, which gave us that founder-derived name, Camden.
And maintaining continuous leadership for over 4 decades, it's incredible.
Remember the scale and position. Nearly 60,000 units, 59,800 to be precise, across 176 communities.
Which makes them a top 15 national owner.
Backed by over $9 billion in total assets. And remember the defining strategic event, the massive $1.1 billion Summit merger in 2005.
Which finalized their status as a major league player, capable of executing deals on par with the absolute largest competitors.
So we want to leave you with one final, provocative thought to explore on your own time, directly related to their established playbook.
We now know CPT is the 14th largest owner, operating with a sophisticated strategy that favors consolidation. So the question we'll leave you with is not simply, will they grow, but rather, who will they absorb next?
That's a great question.
Given their documented and repeated history of targeting large, stabilizing portfolios and their tactical preference for purchasing 80% or the remaining ownership interests in successful joint ventures,
You have to wonder what's on their radar.
you have to consider which existing mid-sized regional players, or perhaps even which co-owned JV assets, might be the most logical and strategically rational next targets for a full takeover. That history, that relentless focus on pursuing 100% control, control is the clearest possible roadmap to understanding CPT's future growth trajectory in this competitive U.S. multifamily market.
Thank you for joining us for this deep dive into the corporate empire of Camden Property Trust.
We hope you walk away feeling thoroughly well-informed and ready to analyze the next big real estate merger.